How do we make investments? Part 3, the loanable funds market. This is going to be a market like any other. It's going to have a price. The interest rate is the price of a loan. Who are the suppliers going to be? Savers. Savers have funds and they deposit it in the financial institutions, thus supplying the funds for banks to use. Well, who demands these funds? Borrowers. Sometimes it's consumers with credit card debt, mortgages, auto loans, and student loans. Other times it's businesses, small business loans, large corporate loans, etc. Understanding this market will help you understand interest rates, where they're going, what causes them, the forces that move them up and down, and also that quantity, how much investment occurs in an economy. Why do some countries have little investment? Why do other countries have more investment? Let's talk about the demand side for loans. Why do firms and people take out loans? Why don't they just use their own savings? Well, because they have a project right here and right now that will pay out more than the price of taking out the loan. The rate of return is higher than the prevailing interest rate for the loan. If the market for loans has a lower interest rate, more projects will be profitable, and therefore that quantity of loanable funds demanded will be higher. This gives us a downward sloping demand curve. Higher real interest rates means less projects are profitable, less loans will be demanded. All right, now savings. Why do people provide savings? Well, what else are you going to do with your money? Oh yeah, spend it. We like spending on things. We like spending on things a lot. It's like the whole point. It's like the whole point of an economy, to buy food and shelter, recreation, nice stuff if you can afford it. Okay, but why don't they spend all the time? Well, they have to save. Why do people like saving? They're worried about risk. They're trying to mitigate risk in the future. But number 2, you get paid to save. The return on savings is the opportunity cost of spending. Spending isn't just the dollars you spend to buy a thing. It's also the next best thing you could have done with those funds. Put them into an interest-bearing savings asset and yield a return for the future. Therefore, the higher the interest rate for savings assets, the higher quantity of funds saved. This means our supply curve for loanable funds is upward sloping. If we want more spending in an economy, we need lower interest rates. If we want less spending in an economy and more savings in an economy, we want higher interest rates. Let's put them together. In the equilibrium interest rate, it means the quantity supplied of loanable funds is equal to the quantity demanded of loanable funds. Sometimes this is called the neutral interest rate. And in the other market, when supply equals demand, yields us an equilibrium. Now, what would cause savers to change their behavior for each and every interest rate? We're going to shift the supply curve. That's the mechanical phrase for simply saying, what causes you to change your savings behavior that is not related to the real interest rate? Because that axis is the real interest rate. If we're just changing interest rates, you're just going to move along that curve. We need to model other behavioral changes as well. Number 1, people's personal savings rates can change. Perhaps they're a little more scared for the future, so they're going to save a little higher. Times are uncertain. During recessions, people's savings rates go high. During boom times, people's personal savings rates decline. It has to do with their sentiments about the future. But individuals are not the only savers out there. Governments are also savers. So a government budget surplus is increasing savings in an economy, whereas a government budget deficit is decreasing the savings in an economy. And finally, we live in a global economy. What happens to savings in other countries will affect the savings in our own country. Oftentimes, people decide to send their savings abroad because they will yield a higher return. If the United States has a lower interest rate, there might be better opportunities elsewhere. Likewise, if another country is saving a lot, they're looking for more and more opportunities to place those savings, and therefore will have foreign direct investment in countries across the world. So, what affects the demand for loans? Number 1, technological advances, new opportunities. There are new places for you to invest. In the 1990s, personal computing became widespread. Everybody started using email and Excel for the first time. All these businesses had to buy all these new computers, and then the computers were changing constantly. A 3-year-old computer wouldn't cut it anymore. You had to replace your machine every few years. That's going to be a lot of investment. They're going to demand a lot of loans to do that. We take out loans and make investment for beliefs about the future. If we believe the future is bright, we will increase our investment and therefore our demand for loans today. On the other hand, if we believe times are going to be bad, we'll make less investment and therefore demand less loans. Corporate taxes can affect this. The higher the tax rate, the less return there'll be on investment. Lower returns on investment means lower demand for loans. And then finally, really important are the lending standards and the cash reserves of a company. If a company has a lot of cash, they're not going to need loans. If the lending standards to get a loan become more stringent, less loans will happen. Now, a separate question is, what is the proper level of lending standards? On the one hand, you need enough to make sure enough loans are happening to make an active economy, but you don't want bad loans to happen. You want to make sure that these loans are going to be paid back. During the 2000s with the housing bubble, the lending standards were far too lax. People were acquiring mortgages without even checking any documentation to see how much income they earned, whether they would even be in a position to pay back those mortgages at all. Let's go through a bunch of examples. China has a growing economy. How would that affect the market for loanable funds in the United States? When people get richer, they have more money. And when people get richer, they save more. They don't have to spend as much money meeting their basic needs and can therefore afford to have a higher savings rate. What are they going to do with all those savings? Supply them for the whole globe. This will increase the supply of loanable funds across the market, which in turn gives us a new equilibrium with a lower interest rate and a higher quantity of loans, more activity, more investment. So we're now seeing baby boomers starting to retire. What do retired folks do with their savings? Do they create more savings or decrease the savings? They're going to start drawing down their savings, meaning a smaller supply of loanable funds at each and every interest rate. What's the new market equilibrium? Higher interest and less loans, less investment. This is a phenomenon we're starting to see right now. Previous to baby boomers retiring, they were planning for it. The savings was higher. That put downward pressure on interest rates. Now that more and more of them are retiring, it's putting upward pressure on interest rates. After the financial crisis of 2008, lending standards increased. It became more difficult to get a loan, not just in the housing industry, but across the economy. Banks were very worried. It was much harder to get a loan for that period, and therefore the demand for loanable funds will go down. The new equilibrium has a lower interest rate, as well as less loanable funds, less investment, less activity. For a brief period in 2008 and 9, the lending standards were too strict. Many viable businesses were not getting loans. There was a bit of a temporary overcorrection. What happens when the government passes a clean energy bill, which will subsidize private investment into green energy? Now the rate of return for companies building new green energy projects has become higher. They will demand more loans. The new equilibrium will yield a higher interest rate and more loanable funds, more investment activity. In the next few years, the demand for artificial intelligence computational capacity will increase. We'll need to build a whole lot more servers and a whole lot more software. And building all of that will increase the demand for loanable funds, higher interest rates, more economic activity. These big questions about where interest rates are going has been an active discussion among many economists. We can see some of these long-term trends by looking at the interest rate over the past 70 years. This particular graph looks at the interest rate for the 10-year Treasury security. Interest rates were closer to 2.5% in the 1950s. They continued to climb until 1980. This was reflecting a lot of the inflation in the 70s. And then not only did they decline throughout the 80s, but they continued to decline through the 90s, the 2000s, and even further in the 2010s. Over the past couple years, the interest rate has been rising again. Many wonder if this trend will continue. Some of what we previously mentioned. We can see the baby boomers saving for retirement, increasing the supply of loanable funds as one of the drivers for lower interest rates. And since the 2000s, there's been a discussion in the slowdown of the productivity growth rate. The economy's not growing at the same pace as it was before, so there's less investment opportunities, a lower demand for investment. That will yield a lower interest rate. And on the other hand, the type of investment we did see was largely digital in nature. It did not require as many funds. We didn't have to build brand new large factories like we had to with the investment in the 60s and 70s. The big debate going forward is whether or not investments in green tech and investments in AI will be enough to spur the demand for investment like it had in the past, or if this downward trend will continue. The retirement of the baby boomers and the slowdown in Chinese growth both will have negative effects on the supply of loanable funds, thus increasing interest rates. However, a lot of the tech investment of the future will remain largely digital and not require the same quantities of the past. However, on the other hand, interest rates might continue to be lower after the inflation spell because most of this investment will simply be digital and not require the same quantities of the past. These things matter. The higher the interest rate, the higher the return on savings for investors, and also the higher the borrowing costs for governments. If interest rates remain high over the next 10 years, governments won't be able to run the same size of deficits that we've seen for the past few decades, which may require higher taxes and less spending going forward.